Well, hey everybody, and welcome to the Animal Donut Channel. My name is Jeff Luke. I'm a professional photographer, and I'm the author of Stock Market Intelligence. And today, I want to show you a tool that's going to help you to become a much better investor. So the one thing I want to be really clear about when we start out here is that I believe in intelligent investment. And at the heart of that matter means I think of investment as buying a piece of a company, buying a piece of a business where I become a part owner. And in general, when you invest this way over time, as the business grows its profits and becomes stronger, then the value of the stock also increases in value. Now, the other way that some people participate in the stock market is what I would consider gambling. And gambling is buying a stock and hoping that the stock price goes up. And there's a lot of energy and time and thought that goes into trying to figure out and predict stock prices, but none of them are based in this kind of thoughtful understanding of the underlying business. So I just want to be clear that this has nothing to do with predicting stock prices, and it has everything to do with investing in companies. Intelligent investment in companies. So this tool I want to show you is called the Palms investment filter, okay, or the Palms filter system. Now I thought this up, so this is not something you're gonna read about anywhere else. It's in the book that I just showed you, but otherwise I don't think you're gonna find this, because it's something that I innovated because I wanted a tool that I could use that would help me to select stocks. And I've been using it for years, and I find that it works really well for me. So I want to tell you a little bit about it, and maybe you'll find a way that will help you to study and to understand stocks when you research them. So the reason that I chose the Palm filtering system, the Palms filtering system, is that when you look at the palm of your hand, you've got 5 fingers, and there are exactly 5 steps to the Palms filtering system. The P stands for profitable, the A stands for apex, the L stands for loyal, the M stands for moat, and the S stands for sensible. So anytime you want to put this to use, just look at the palm of your hand and you will be able to remember these 5 steps. So let's look at them one by one here. The profitable part, the P from Palms. Profitable companies prove that they can make money over time, okay? This is obvious, but a lot of times people have been buying stocks in companies, and in the last several months we've seen a lot of these companies that people thought were profitable actually aren't making money, and their stock prices have just gotten hammered. When you look at an entire universe of stocks, when you only consider those that are profitable, it's like a funnel, and it just narrows it down to a smaller group, a smaller subset of stocks. How do you do this? Well, you look at the income statement, which is one of a company's financial statements. I will show you how to do that in another video. It's not crucial for this one, but just keep in mind that when you're considering stocks for investment, if you look only at profitable ones, you're going to be thinking like an intelligent investor. If you buy stocks in companies that haven't yet earned money that surpasses their expenses, you're speculating, and you're hoping that perhaps in the future that company may be profitable. But that, to me, is not intelligent investment. So apex predators, in the natural world, an apex predator dominates their ecosystem. Well, with investing, an apex company is like a predator that dominates and innovates in their stock sector, in their industry sector. So I'm going to give you a few examples of those. Here are a few companies that you've undoubtedly heard about: Apple, Amazon, Nike, Disney, Starbucks, Nvidia, and Viva Systems. There are hundreds of other companies, but all of these, when you look at the sector of the industry they're located in, they are at the top. And the value of investing in apex predator kind of companies is that they don't have to worry about getting squeezed out by smaller, less strong industries or by less strong companies. So I'll just give you an example of an animal, okay? The otter, right? The otter is actually an apex predator, even though, it's a small kind of fuzzy mammal that lives in the water, but they are able to fish underneath the water for fish and for shellfish and mollusks and clams and stuff. And then they can also grab like birds and things that are flying over the water, and they're super versatile, but they have no natural predators. And so that's an incredible kind of asset for the otter and its ability to eat and thrive on all kinds of different animals, but have nothing that directly threatens it. And so when you're investing in a company that's an apex predator, whether it's an Amazon or an Apple or an Nvidia, these are the most dominant, most powerful, most innovative companies in their sectors. And so when you go with those types of businesses, you get a kind of built-in insurance. Now, L is for loyal, and these are companies that have loyal customers. And these are people who come back and they buy every week and every month and every year. And so what you want to do is find companies where there's this kind of built-in recurring revenue, which ensures that over time you are going to be continuing to get money without having to worry about things drying up. So a really good example of loyal customers would be, for example, like Apple, okay? Most of the people who buy Apple iPhones, when it's time to replace that phone, they replace it with another iPhone. They don't go looking for other companies that make phones. And so when you think in terms of this repeat business, it just grows on itself. Amazon's another great, people buy Amazon Prime, and then once they're a member, once they're a part of that family, they come back, they go online when they need to buy something, and they buy from Amazon again and again and again. Costco's another great example. People are fiercely loyal when it comes to Costco. You probably have friends like this if your own family is not a member of Costco. And people who are Costco members are just so devoted, such big fans that they go there every week and they stock up and they buy stuff. So anyways, loyal customers are an asset to these companies. And then a moat. A moat is a durable competitive advantage that a business has. And this means that they don't have to worry so much about other companies coming and taking their customers. They're kind of resistant to competition. So I'm going to give you a few examples of companies with wide moats. Here are a few of them. Microsoft is one. Apple, Nvidia, Viva Systems, Salesforce, Zimmer Biomet, Starbucks, Kellogg's, Disney, Coca-Cola, McDonald's, Equifax, and Biogen. These are all companies that in their own sectors have a kind of built-in protection. I mean, when you think about, say, Coca-Cola, it would be really hard. I could give you 30, 40, 50 billion dollars and say, come up with a soft drink that can outcompete Coke or Diet Coke or whatever. And you just can't do it. Think about Starbucks. A lot of people have Starbucks built into their trip to work or to their travel plans. They like to stop off and get coffee at Starbucks. And it would be very hard to build a competing coffee chain that puts Starbucks out of business. So anyways, when you look at companies, look at ones that have a real dominant hold on their customers, where people are loyal, but they come back because they make it very hard for other people to unseat them. Amazon's got one of the greatest, online retail moats, because other companies who start up, who try to sell things online, all have to somehow beat Amazon's selection or prices, which is insanely difficult to do. And finally, sensible price. No matter how amazing a company is, it's not worth an infinite price. So once you've figured out the first several steps here, you want to do some careful thought and study and come up with a price that makes sense to you as an investor. and only buy the stock if it passes these 4 filters, but also is available at a sensible price. And I have found that sometimes you'll find companies that are profitable, apex predators, loyal customers, and have moats, but the prices are really high. And that makes sense because these companies are so amazing and powerful that people are willing to pay really high prices for them. But this doesn't mean that they never become cheap. And I've noticed with a lot of the stocks that I own and that I follow, there are times, sometimes you have to be really patient and wait a year, 2 years, 3 years, but invariably something happens in the economy, something happens in the political world, and it affects all the investor sentiment and it drives the stock price down, even though the company itself is still amazingly great and very well run. The price comes down. So sensible price is the 5th and final step of the PALMS filtering system. Now I think you'll be able to remember this because all you have to do is look at your hand and remember PALMS, and each one of these items will come to mind. So just to recap, PALMS is an investment filter. It's a tool that you can use, and this is part of your investing education, okay? I'm not saying this is the only way to research and to study stocks, or the best way. It's something that I have developed and I have used it myself, and I found it insanely useful. It gives me a foundation and a way to think about things in a digestible, in a very methodical and thoughtful way. And just to wrap things up here, I find this just fascinating, and I think this will help you to kind of clarify and solidify your own way of thinking about stocks. If a business is profitable, which is the P at the beginning, and you buy the stock at a sensible price, which is the S at the end, then it's really difficult to lose money in the long run. Think about that. You're buying a profitable company, the stock in a profitable company, and you're buying it at a low price. Over the long run, you're gonna do really well as an investor. Now, let's invert that, okay? Let's flip that upside down. If a company is unprofitable and you overpay for the stock, it's gonna be really hard to make money over time. Now, this is a lesson that a lot of people learn the hard way over the past several months or the past year or so. So they bought stock in unprofitable companies and they paid a lot for those stocks. And they just got crushed. They were disasters. People lost 30%, 50%, 75% on their stocks. And they didn't really know why. But now that we look at it, we can see they were buying unprofitable companies and they were paying a lot. They were paying really high prices. So, always invert, always flip things upside down and look at them from both ways. What's the best way to lose money? Unprofitable companies at high prices. What's the best way to make money? Profitable companies at very low prices. Whenever you have a problem or something you're trying to solve, always invert, just flip it. So, just to have a little take-home message here, I use this simple filter, the PALMS filter system. It works for me. Try it on your own as you study stocks. It ensures that you look at a company and that you're not just looking at the stock price. So now you have a new tool that you can use, the PALMS filtering system. It's a simple filter. Let me know what you think. Give it a try. Use it. Please, if you like this video and it gave you some new information or some new way of thinking about studying and picking stocks, please like the video. That way the YouTube algorithm will know that this is useful to you and it will suggest it to other people. And also please consider subscribing to this channel if you want to see more videos that I make that will help you to learn more about investing. So, tell your friends about this channel. Let me know what you think about it, and I will see you in the next video.